now for the another Kickstarter session, may we please call on the stage to speak on the alternative investments in public equities, market views, and investment themes and opportunities. Prashant Jain, 3P Investment Managers. Everyone, a big round of applause. And a small intro for them, a little really small over here. Prashant Jain was a Chief Investment Officer at HDFC Mutual Fund, leading mutual fund of India from 2004 to 2022. Oh my God, a big number. During this tenure, HDFC Mutual Fund asset grew from approximately rupees 3,000 crore to approximately 4,40,000 crores. Of this, approximately 235 crores was the equity of oriented funds. My God, I must say these are very big numbers. All right, he has 31 years of investment management experience. Prashant also holds the distinction of being only fund manager in India and one of the few globally to have continuously management in the scheme over 28 years. The fund, namely HDFC Balanced over here, Advantage Fund, earlier also known as HDFC Prudence Fund over here, a hybrid equity debt fund, delivered a CAGR of 19 over here, 17.9, and between Jan 1994 to 2022 over Sensex of CAGR of 9.6% in this period. Apart from these so many, he has been awarded the fund manager in India. He has also got this distinction of being the only fund manager in India to have managed 1 lakh crores of equity funds. He has also called a day when the HDFC performance investment over here was very strong and ensured to have seamless and a very smooth transaction. He also has the PDGM over here, apologies. He also has his PGDM from the Indian Institute of Management, Bangalore in 1991. Before this, he obtained a bachelor's degree in mechanical engineering from India Institute of Technology from Kanpur again. Over here, Prashant has worked with SBI Mutual Fund from 1991 to 1993. Over to that, as well as with Zurich India Mutual Fund from 1993 to 2003 in different capacities. He moved to HDFC Mutual Fund, subsequent to take over Zurich India Mutual Fund by HDFC in 2003. He is now the process of setting up a boutique investment fund focus, a long-time investment. Everyone, a big one for them. Can we have Prashant sir on the stage? Good morning, sir. How are you doing today? All well. Okay. So how are we doing today? First of all, I want to know that a big career, what message you want to give it to the audience, and I can see, you know, to listen to your presentation ahead. Any message you want to give once before we start?
Be optimistic and be patient.
All right. So let's hear to that and ready for the session. Thank you so much. Over to you.
Good morning, all of you, and it's a pleasure being here. And I thank FinTech for giving me this opportunity to share some thoughts with you. So the tagline says, "You manage the alpha and you'll do the rest." So I have only endeavored to generate alpha throughout my life, throughout my career, and I know very little about the rest of it. So, but I believe our firm is in good hands. So I'll try and share with you some thoughts around the Indian economy and the markets, and if you have some questions around investing or prospects of economy or how I have managed funds, I'll be happy to answer the same. Can we have the slides on? No, no, it was mailed. Okay, no problem. It was mailed yesterday, I think. No, not received? Okay. Sure, so let me spend some time sharing some thoughts and then I'll refer to the slides. See, the Indian economy has grown without a break for as many decades as you can go back. I have seen it myself for the last 3 decades. There was only 1 year in last 4 decades where the India's economy contracted. Would anyone like to guess which year was that? It was the COVID year. So even in the Lehman year, our economy grew. So why has this economy been growing? It's been growing for a variety of reasons. I mean, people worry about governments and interest rates. But if you look at the growth of India, you will realize that most of what goes around does not impact growth in India. And growth has been virtually, without a break, we have been growing. See, first of all, we have great demographics in this country. We have had good demographics for last few decades. What is good demographics? It is basically a growing population and a young population. A typical person, most of us, we earn, spend and save the maximum in the working age group. So the more the number of people in a country in the working age group, the more is the economic activity. This demographics is becoming better now because not just in absolute sense, but more important in a relative sense. If you look at the world around, US working age population growth is becoming zero now. Europe is degrowing. China has begun to degrow since 2015. Japan has been degrowing for last almost 30 years. So India's demographics is not just good, it is actually good in an environment when rest of the world, the developed world, is actually experiencing shrinking working age population. And this opens up a great opportunity after COVID. In COVID, the acceptability of remote working from home went up exponentially. What would have probably taken 10 or 20 years has happened in a matter of 2 years. And now when you look at this, it throws up a great opportunity for India because a lot of jobs that are desk-oriented jobs, if someone is allowing that work to be done off premises from your homes, then might as well move it to Bangalore or Chennai or Hyderabad. And when we look at global Fortune 500 companies, I think an increasing percentage of their workforce is now moving to India. So other than the front line functions, the functions in sales, other than the critical roles, other than the very senior management roles, which they don't want to offshore, I think jobs in accounting, taxation, back office, legal, HR, payroll, back-end R&D, transcription work, all of this can over time move into India. So I think this is a great opportunity because if you have young people without jobs, it creates a lot of problems. So I think we are in a good situation that we have lots of young people. India will account for almost 22% of the workforce addition in the world for next few decades. And this along with the environment of remote working acceptability, I think a lot of jobs will be available to this large pool of people. Think of it this way, up till now only software services have been offshored to India. But leave aside the tech companies. If you look at normal companies, probably 5 to 10 times the jobs are in non-tech areas, in functions like accounting, back office, taxation, all of those. And now these can move to India. So I think the opportunity now in offshoring is several times bigger than what we have experienced thus far in IT and BPO. So this is one very large opportunity that India has. And I think COVID has in a way accelerated this opportunity. Let me now share with you some thoughts around manufacturing. The trade in manufacturing or the trade in goods precedes trade in services. Goods have been traded across countries for centuries. But when was the first time you think services got traded across countries? Leave aside things like airlines or tourism. But when do you think the first real trade in services started happening in the world? Services by definition cannot be traded across countries. So I think the India offshoring of software was the first genuine cross-country trade in services. Before that, there was no trade in services on a cross-country basis in a big way. But trade in goods has preceded trade in services for many, many centuries because you can ship goods far more easily than you can ship services. So I think, and the when you are trading in goods, you can make for the whole world. Whatever, if you can make something of good quality at a cheap price, the whole world can be your market. That is the nature of goods. So what happens that when any country acquires competence to make goods, good quality goods in a cheap, cost effective way, it tends to create very large degree of employment, and that country grows extremely fast. And as that country grows fast, because you are making goods for the whole world, you create a lot of employment and wages go up very sharply. And when that happens, that country over time loses competitiveness. So if you look at the history of manufacturing, UK was the first country to industrialize in early 19th century. And after that, in last 250 odd years, manufacturing has gone around the world from UK to continental Europe and US in early 20th century. In 60s, 70s and 80s, Japan benefited a lot from offshoring of manufacturing. As Japan salaries rose, they lost competitiveness. It moved to Southeast Asia and Korea. You would recall the term Asian tigers. It was used in 1990s. It was referring to economies like Thailand, Malaysia, because they were benefiting from going manufacturing footprint in those countries. And post 2000, China has been the fastest growing factory in the world. China joined WTO in 2003, and China was extremely competitive. Chinese per capita income in 1990 was about the same level as India, and today they are 5x. Why? Because manufacturing is a very, very large opportunity, and China has done extremely well in manufacturing. Just 0.5% of manufacturing is equal to the software service exports out of India. So manufacturing is such a large opportunity, and this was the reason why China grew almost 10% back to back for 3 decades. And today their per capita income after 3 decades is 5 to 6 times of India, and 30 years back the per capita income was same. So the point I am coming to is that the global environment and India's positioning is very conducive for India to gain or grow share in manufacturing as well quite fast. Would you like to guess if of all the Asian countries, let's say countries like Vietnam, Thailand, Indonesia, Malaysia, China, India, in which country the manufacturing wage inflation has been the lowest in last 10 years? Would anyone like to take a guess? So Bangladesh, I am not aware. Bangladesh, Pakistan, Sri Lanka, I am leaving out because Bangladesh is basically textiles manufacturing, nothing else. No, it is India. Actually, Vietnam is the highest. In Vietnam, wages have gone up 4 times. If they manage to put that slide on, I will show it to you. So what has happened? Manufacturing has bypassed India. We haven't evolved into a global factory at all. So therefore, the manufacturing wage inflation in India is been the lowest. So 10 years back, manufacturing salary in Vietnam was less than half of India. It was actually 1/3 of India, and today it is at par with India. So Vietnam has grown the fastest, the salaries, because as China became expensive, Vietnam is an adjacent country. So the Chinese companies have relocated factories into Vietnam. And Vietnam is a small country. It is roughly 4 times the size of Mumbai, or maybe even 3 times. So Vietnam has a 10 crore population and a 5 crore working age population. So when you move large scale manufacturing into Vietnam, you achieve full employment very fast. And that is what is happening in Vietnam. So what has happened because of our non-performance, I don't want to use a stronger word, but because of our non-performance, India's is now gaining competitiveness in manufacturing. Because we are becoming our wages are now the lowest in Asia, and Asia is the lowest in the world. So 10 years back, our wages were 30% lower than China. Today they are about 60 to 70% lower than China. And China is also beginning to age. In every year, the working age population in China will continue to dip. So governments may do whatever, but one thing that has been observed that as income levels go up, as women become literate and as they join the workforce, birth rates fall very sharply, and there is very little you can do to reverse this trend. So China is degrowing, so wage inflation in China is unlikely to reverse. So India has gained cost competitiveness in manufacturing, which is a massive opportunity. Just 0.5% of manufacturing is. Okay, thank you. So this is what I was discussing. This is you can see the working age population in 5 key areas of the world: US, Europe, India, China and Japan from 1990 till 2050. And you can see that all but India are either flat or degrowing. And this is what opens up a massive opportunity for offshoring of services because of high acceptability of remote working, etc. And this is what I was discussing around manufacturing. And you can, if you focus on this chart in the middle, the bottom mid chart, the blue bars, they give you the salaries in dollars per month in these 5 countries in the year 2000. And the orange bars are the salaries today. And that is what you can see. Vietnam, the wages are up 3.5 times in last 10 years. Cambodia is up 3 times. Thailand is more than 2 times. China is more than 2 times. India is up 30-40%. And you can see India has become by far the most competitive in wages. Along with cost competitiveness, there are 2 more things that have changed. In COVID, if let's say a global multinational, let's say like a Siemens or a whatever Toyota had 2, 3, 5 factories in China, all of them went into lockdown. So by diversifying manufacturing across sites, you did not manage to reduce the risk because the whole country went in lockdown. So now there is a key issue or key need to diversify manufacturing or your supply chains, not just within a country at multiple sites, but across countries. And therefore, these large companies are looking for an alternate to China where they could put up some factories as a de-risking measure. And I think a third thing has happened post-Ukraine. India is the same what it was 3-5 years back, but on a relative sense, it has become the good boy in the world. Right? So we haven't done much. I mean, we are maybe good earlier, good now, but in a relative sense, certainly the geopolitical risk that is attached to India or perceived in India is very, very low because that risk has gone up in other countries. If you had investments in Russia, post sanctions, those investments have become worthless. Right? So if this same thing were to happen to some other country where you have large investments, then that is again a very large risk. So I think India is gaining in favor big time as a manufacturing base for reasons of cost, for reasons of de-risking and for geopolitical reasons. And as I said earlier, manufacturing is a very large opportunity, much larger than services, and you can read it in the second line. Just 0.5% of global manufacturing is 110 billion US. It is 4% of India's GDP. And that's why you will find a very strong linkage between growth in manufacturing and GDP growth. So whichever country gains traction in manufacturing, their GDP growth accelerates. It happened to China in last 20 years. If you look at this chart, the bottom right hand side chart, the yellow line, that is Chinese share of Chinese manufacturing or Chinese exports in global exports. So China was 2.5% of global manufactured exports in 2000 and today they are 12.5%. So they have gained virtually 0.5% market share every year for 20 years. and this is what lifted their growth to close to 10% a year. So I think India is now approaching this sweet spot that given our demographics, low wages, a reasonable social, political, economic environment, stability, democracy that is ingrained in us, improving infrastructure, improving ease of doing business, rankings, geopolitics, and de-risking, reducing dependence on China. I think all of this is coming together, and I think it is not too far away when India will start seeing greater traction in manufacturing. And this is why I feel that the growth of India's GDP of 6% last 20 odd years, in the next 5, 10, 20 years, we should hit 7, 8% easily. Some people think we may even grow at 10%. I personally feel that is possible, but less likely. I would not, because India is a very complex country, unlike a Vietnam or a China, because there, once the government says something, things happen overnight. In India, things move slowly. Change is extremely difficult in India. So people who monitor India every day, they are always frustrated with this country. So therefore what I do is I look at India after 10-year periods. I look at, if you want to feel optimistic in India, look at what India was in 1990, then 2000, then 2010, 2020 and 2030. And every 10 years you will find things improve for better here. But if you read the headlines every day, you will be very disappointed. But that's the wrong view of India, because it's a society, it's a democracy, federal government, state government, municipalities, central government, NGOs, media, judiciary, bureaucracy, and everyone has their say, and everyone has their opinion, and everyone has their style of working. So to bring about change in India is very, very slow, very frustrating. But we are moving in the right direction. Therefore, I feel because of this slow pace of change, despite the best of intentions, we may not be able to grow at 10%, but I think 7, 8% is easily doable for us. And there is one interesting data point here. If you look at this bottom left-hand side chart, this is the foreign direct investment in India and China as percentage of the two GDPs. So you will see 10 years back, India's FDI was lower than China relative to its GDP, and today we are higher. See, manufacturing will move to India not without the global multinationals, because it is the global multinationals that have the technology, the expertise, the brands, the customers, the processes. So unless they move into India, it will be very difficult for you to crack the manufacturing piece, and that's why I think FDI is a very good indicator. And I would expect this FDI should actually shoot up post-Ukraine and post-COVID in the next 2, 3, 4 years. But manufacturing, unlike services, while it's a very large opportunity, it's a very slow-moving opportunity. So you can shift 1,000 jobs from London or New York to Bangalore in few weeks. Maybe KFinTech can do it in days. But to move a factory, it will take you 3 to 5 years. So I think this is like a giant ship. It will take time to gather momentum, but I think we are now moving in that direction, and the next 2, 3 years, the results of this should be visible. You can also get a sense of this if you read the papers carefully. And if you read the papers, you will see that global CEOs are visiting India far more regularly, and everyone is saying how much incrementally they will invest in India. So whether it is manufacturing companies, pharmaceutical, every week you can see an interview of some or the other global leaders being in this country. Let me now share with you one more thought. This is a very simple thought, and there is nothing unique about this. How many homes in India have an air conditioner, in your opinion? It is about 5%. So if we have an air conditioner at home, it means we are in the top 5% of this country. And about 10% homes have a car. So India is a very poor country. It's a large economy, but the population is much larger. So it's a very poor country, and that becomes an opportunity for huge growth. If you create jobs in India, the room for consumption to grow is, I mean, huge. 90% homes still without a car, 95% homes still without a air conditioner. How many Indians fly in a year? Any guess? We have a population of 140 crores. How many people fly even once a year? Just about 4 crores. 4 crore people fly in this country. So that's why every time you sit on a plane, the person sitting next to you is struggling with the seat belt. Because many are first time flyers, yes. So every year, maybe 10% people are flying for the first time. So you can appreciate the scope for growth in India. So the key is the willingness to consume is there, ability is not there. So now I think we will be able to provide a lot of jobs to this large group of people, both through services and through manufacturing, and that is what should accelerate growth in India. So many people complain about infrastructure, but I think we are all referring to the city infrastructure. So Bombay is crowded, housing is very expensive, it's a dirty city, there is so much garbage. But the moment you beyond cities, the infrastructure for business is actually improving. Our intercity roads are very good. So I have traveled in the last 3 months to states like Bihar, MP, Orissa, and you will be surprised. The roads in Orissa and Bihar and MP are better than Mumbai-Pune expressway. UP roads are better. So I think roads in India have really improved, intercity roads. DFC is coming in. DFC is the dedicated freight corridor. So there are separate railway lines being built only for freight trains. So the average speed of goods trains will go up by 3-4 times, from 25-30 kilometers per hour to 70-80-100 kilometers per hour. Double stacking will come. The length of train will go up to 2 kilometers. So the cost of logistics will drop. We don't complain about our airports anymore. So they are probably as good as the best in the world. Our ports are comparable to the best in the world. Our power rates, something very surprising has happened. I forgot to mention this. Look at the top right hand side. These are the electricity prices in some 8-10 countries, pre-Ukraine and post-Ukraine. So you will see something remarkable. India's power rates are now the lowest between US, Europe and India. So what has happened, India and US, these are the two countries where the fuel for power generation is local. So we import fuel for transportation, but our import of fuel for power is extremely less. And that's why our power rates are so low. Europe has moved from gas from a neighboring country, throwing through a pipeline, to LNG, which will come from US in a LNG carrier, which is 3 times more expensive. So India, apart from low labor cost, also has the advantage of low power cost, which is the second key input in manufacturing. And Europe, the shift towards LNG is permanent. So it will remain very expensive. So you must have read in the papers, I think 2 days back, Bayer or BASF, they have shut down multiple factories in Germany because of high power rates. So I think the stars are getting aligned, and we should look to the future with optimism. India's digital stack, digital infrastructure is the best, airports are best, ports are world class, power is good, telecom is good and cheap. Sometimes you have call drops, but for the price what we pay, I think it is still great value. So I think even the business environment in the country is improving rapidly. Now let me just take you back to one more slide, and then I will. So this is an interesting slide, very simple, but lots of takeaways on this slide. The blue bars, they give you the 4 parameters. Here we are looking at 4 things. Real GDP growth, which is the volume growth of the economy. GDP deflator is nothing but inflation. The nominal GDP growth is the total of real growth, volume growth plus price. That's the third set of columns. And the last is the returns of Sensex from 1980 to 2000, the blue bars, and post 2000, the orange bars. So what you will see here is the real growth in India has improved by 1 to 1.5% after 2000. That improvement, I think, happened because India opened up the economy in 90s. We liberalized to supply side, and also the IT industry gained critical size in those periods. And that is what gave us a lot of jobs. So these two, I think, lifted India's economic growth rates. That 1% improvement is very big, or 1.5%, because over 25 years, it means your economy is almost 40-50% bigger today. So people tend to disregard it. So if you grow by 1% more for next 20 years, it makes a huge impact. So we should not underestimate that. The second set of columns, the GDP deflator, is interesting. What do you see? Inflation in India has literally become half in last 20 odd years compared to pre-2000. So we complain about inflation, but we are not, actually it's not inflation. We are upgrading continuously. And we confuse that with inflation. You are buying an ordinary shirt, and now you buy a more expensive shirt, and you will say, my God, life has become so expensive. You send your children to private schools, and you will say, you arrange private tuitions, and you say, very expensive. It is, the inflation is actually quite low, but all of us have been moving up in what we consume. So inflation in India is quite low. It's about 5% for last 23 years. And this has a message for us for equity returns, and that's why I'm explaining this. You can see the Sensex returns are very close to the rupee GDP growth of the economy. There is a simple reason for that. The simple equities over long periods grow as much as the underlying businesses are growing. Equities are slaves of earnings. And what is the economy? It is the sum total of the businesses. So whatever the economy does in rupee terms in long periods, the Sensex should do very closely that. And that's why in a low inflation environment, you cannot expect 15-20% kind of returns from equities. And when I move around, I feel people still expect 15-20% returns. I don't think that is likely. And you can see the last 23-year returns of Sensex are just about 13% CAGR. So I think in a low inflation country environment, when interest rates are low, you cannot expect 15-20% kind of return. So I think India, we should expect 12-13% kind of returns only in India going forward. Let me do one last exercise with you, and you will, because some people get disappointed with 12-13-14% returns, but let's understand the power of it. So does anyone know when was the Sensex set up? 79. So Sensex was started at a base value of 100 in 1979. From 79 till date, how many years have passed? 44 years. 44 years. Let's round it off to 45 years. I am communicating a message with some approximations, but it should serve the purpose. So round it off to 45 years. Assume that India's economy in 44 years has grown at 14% CAGR in rupee terms. It is actually close to 13%, you can see here. But you can assume 14 because economy comprises of agriculture, manufacturing and services, all three. But no agricultural companies are listed in India. All listed companies are either in manufacturing or services. And these two grow much faster than services, than agriculture. So if economy has grown at 13% for 45 years in rupee terms, assuming 14% growth for manufacturing and services is not aggressive at all. So if something grows at 14% per year, how long will it take 100 will become 200 in how many years if it is growing at 14%? 5 years. If you work on a CAGR basis, it will double in roughly 5 years at 14%. If you divide this 45-year period in periods of 5 years each, what do you get? 9. So that means that in 45 years, the economy, or at least the manufacturing and services, have doubled how many times? 9 times. So please double 100 9 times and see what do you get. So double 100 9 times. No, that is 9 times you have multiplied. Double it 9 times. Because economy is doubling every 5 years. It has doubled 9 times. So like 200, 400, 800. So please double it 9 times. How much? How much? Yes. So if you double it 9 times, 200 first time, 400, 800, 1600, 3200, 6400, 12,800, 25,600 and 51,200. So 100 becomes 51,200 if you double it 9 times. So that is close to where the Sensex is at 58, 59,000. A 10-15% difference over 45 years is maybe 0.1, 0.2% difference per year. 10%, 15 over 45 years. So think of equities this way, think of Sensex this way, that it is doubling every 5 to 6 years. So don't disregard a 12, 13, 14% compounding opportunity, because over long periods of time, it becomes a very, very large number, and that is what Einstein said, that compound interest is the 8th wonder in the world. Those who understand it, they earn it. Those who don't, they pay. So I think India represents a good compounding story, and these are markets that are fully valued. You can see it here in the last orange line. The Sensex returns are slightly ahead of the economic growth. It means there is no valuation catch-up that is left. There is no valuation catch-up that is left. P multiples are not cheap in India. But growth is here, and growth should accelerate. So I think if you buy equities and remain invested for 5-10 years, you should be able to grow your wealth around 12, 13, 14% year. So maybe let me stop here. I can go on, but maybe share with you. So let me share with you what is the risk, because people like me always talk of opportunities. So let us also look at 2 risks. These are probably of academic interest, but still we should be aware. So the red line here is the US Fed balance sheet. And to put it very simply, a central bank's balance sheet is nothing but the amount of money that has been printed. So the bigger is the RBI's balance sheet, it means the more is the money in circulation. Even I am not an economist, but roughly that is what it means. So you can see pre-Lehman in 2007, the pink line, orange line was 0.7 trillion, which means US Fed balance sheet was 0.7 trillion, and post-COVID it became 8 or 9 trillion. So in 13 years, the US central bank's balance sheet expanded 13-14 times. Their GDP would have grown maybe 40%, because US grows typically at 2% a year. So the last 10 years have seen an unprecedented amount of money being printed in the Western world especially. It has never happened before. So the magnitude of money printing, for whatever reasons, whether it was Lehman or COVID or economics or politics, we don't know, doesn't matter. But the amount of money that has been printed is very, very unprecedented. When you put in out lot of money and don't, then inflation is a normal result, and that is what the world is experiencing now. So there is inflation, interest rates are going up. US cost of capital has moved up from 1% to 4%. No one knows how high it will go, but that is a risk. That if US cost of capital moves up even higher, higher cost of capital is not good for asset prices. So this is something that we should be aware of, and this is a risk to global markets, to Indian markets. This is not a risk to growth in India, to my mind. It can impact capital markets for long periods. If our markets fall sharply for this reason or some other reason, you should buy equities. So, because equities have one more unique characteristic, and let me do this exercise with you. So, Indians love gold, right? If gold prices fall, what do? You buy more or you sell what you have? Yes, most of us would buy more. If gold prices go up 20% in next 6 months, what do? You will buy less or you will buy more? People will buy less gold. And how often do you value your gold? Do you get all the ornaments every day, take an inventory, multiply it by the price, and then say, my gold is worth so much? You don't do it. But now you look at equities. Tomorrow there is some headline, an index drops 10%. What do? Do the majority invest more in equities or do they run away from equities? They run away. If markets go up, if they keep on going up, the investments also become higher and higher. So now this is the question for you. Why are we behaving so differently between gold and equities? You got the answer, right? So think about it. The answer is very simple. I'll share it with you. But just think for a moment, why does the same person behave so differently between gold and equities? Any guesses? Pardon? So see, people will give you various reasons, like he said, perception of future value, someone said long term, someone said gold is tangible. The real answer to my mind is, in gold, without realizing it, because we have grown that way. In gold, we are very long term investors. We never think of selling gold. In fact, we feel very upset if we have to sell gold, culturally, if something terrible has happened. So we just pass on gold from generation to generation. We are very, very long term investors in gold. And that's why if prices fall, we think of it as an opportunity, because in the long term it will go up, and vice versa. If it goes up sharply, we'll say let's hold on. We are price conscious also of what we are buying. In equities it is the opposite, because we are not thinking 10 years, we are not thinking 20 years. We are thinking weeks and months, maybe a year. So if prices fall, prices will fall when there is some challenge. Prices will not fall in a great environment. So you think it will fall further, and that's why you don't buy or you sell, and vice versa. So the key is to start behaving in equities like the way you behave in gold. If you do that, you will realize equities are far more powerful, because gold will compound at 6-8%, equities will compound at 12-14%. So I don't know what I was saying. So what was I covering? I diverted for a moment. So anyway, this is one risk. The point I was making is, should equities fall for some reason, then don't panic. Behave in equities the way you behave in gold, and think 5 years, lower prices are good for higher returns in equities longer term. The best investments in equities are always made in crisis periods, and vice versa. The biggest mistakes are made in the best of times, because in the best of times everything is very expensive, and the best investments are made in the worst of times, because everything is very cheap. So learn to differentiate between perceived risk and real risk, and if you can do that, then you will gain more out of equities. And this is why Warren Buffett says that equities, you need more EQ than IQ in equities. EQ is emotional quotient. That when COVID hit, when prices are very cheap, do you have the strength to buy? And that's why I said in the beginning, when she asked, what is your message? Be optimistic and be patient. Because at COVID, to buy equities, you have to be an optimist. And patient investors are rewarded the most in equities because compounding takes time. So one last risk, see, this ESG is a very good thing, but if you are the managing director of an oil company and the world is telling you, economists, experts, everyone is telling you that by 2040 the demand for oil will be down 80% or whatever. It takes 10 years to open up an oil well. So if you start digging for a well today, it will be ready in 2030, and by 2040 you find that oil may have no takers. So you will not start investing in a new well because you have only a 10-year window to sell, and the life of an oil well or a coal mine is 40, 50, 60 years. So because of this likely switch, expected switch towards green energy, solar, wind, nuclear, hydro, whatever, the investments in oil and coal have gone down very sharply, and you can see that here. And this is a risk because demand will shift one day, but if the supply falls faster than the demand shifts or the reduction in demand, then it could lead to very high oil prices for some few years. It is possible. So that is a risk for India because India imports large amount of oil. So this is it will slow us down, it will not kill us, because between 2000 to 2008, oil prices went up from $10 to $140. It still did not kill us because our software exports also grow every single year, and our software exports are roughly the same size as our oil imports. But nevertheless, that can put some pressure. So this is one possibility, one risk. So let me stop here, and in case you have any thoughts, views or clarifications, I will be happy to answer. Yes, please.
Sir, I'm sure you're expecting this question. What are your views on Adani?
I think the businesses are, some of the businesses are very strong. So if you look at the ports business, if you look at the airports business, these are very strong businesses. I think the prices ran too ahead of fundamentals. And that's why I think, and you can see it, I mean, if you look at last 5 years, 10 years, you can see the price appreciation has been much higher than the growth in profits. So we must distinguish between good businesses and good prices, good businesses and good investments. So I can give you examples from IT companies, I can give you examples from consumer companies, from pharma companies, where even if you bought a good business at a terribly wrong price, it has been a very, very bad investment. So, I mean, that's what I would say, that please focus on the price. Most people invest in a business only by looking at the direction of price movement. And they are not conscious of what are they getting and what are they paying. And that is why most of these mistakes happen. Yeah. But I was not expecting that question. Anything else? Great. Yes, please.
So I just wanted to understand more on the consumption story of India. You said that the inflation is really not that high. So my question is basically just, is the consumption in India is declining, or is like it has stabilized, or you still see a large growth coming in the consumption side in the terms of volumes from the rural or in the urban side?
So see, consumption will keep on growing in India, but you need to, don't confuse inflation with consumption growth, because inflation, there are two ways a business grows: volume growth and price growth. So low inflation means that the company's sales in rupee terms will grow lower to that extent. But to that extent, your interest rates have also moved lower. And to that extent, your long-term equity returns will also be lower. But I think the growth in consumption will depend on the category. When I passed out of business school, I think in 90, the toothpaste penetration was probably 50 or 60%. Today it is maybe 90-95%. So you can't expect toothpaste to grow volumes 5% a year when population is growing 1% a year and 95 out of 100 people are using a toothpaste. Unless you and I start using double the amount of toothpaste as those ads prompt us. But we are smarter than that, right? But if you look at cars, it should grow faster because only 1 in 10 families own a car. Air conditioner should grow even faster. So growth in consumption in a category is a function of the penetration levels and income levels. So air conditioners are not growing fast because it is cheap to install but very expensive to run. It costs you almost 10 rupees per hour. Say if you run it for 5 hours a day, it is 50 rupees in one room. 30 days, 1500 rupees. 2 rooms, 3000 rupees. 2/3 of India earns less than 35,000 rupees a month. So a person earning 35,000 rupees a month, he may even buy a second-hand air conditioner, 5,000 rupees, that's okay. But who is going to pay for the operating cost? So you have to look at the penetration of a consumer category and the affordability. And the last thing is, but some people, they look at this low penetration and they'll go and buy these stocks. And they are disappointed because this leads to volume growth. But for profit growth, what is also important is what is the nature of competition, what is the nature of the product. When you are buying a skin cream or a soap, you are more brand conscious. But when you are buying, let's say a toaster or a fan or a light or a pipe or even an air conditioner, you may be less brand conscious. You may be more price conscious also. Price is a very important, or availability, or what is your carpenter or plumber recommending. So I think the category growth you can forecast easily, but to buy the business, you must understand the pricing power, the competitive position, and above all, what are you paying for that business. So recently you have seen e-commerce business in beauty products is down 70%, right? So it's a good business, it's a first mover, but you paid a wrong price. You paid a multiple of 2000 times. So if you buy something worth at 2000 times, even if the profits grow 10 times, it is still 200 times. If they grow 40 times, it is still 50 times. So if you pay a terribly wrong price for a good business, it will not turn out to be a good investment. So you have to look at all of these things. Yep.
Morning,
Yes,
sir.
yes, please.
Thank you for injecting the optimism in all of us. And whenever I hear you speak, I resolve further to postpone my redemptions in equities.
Good.
So a question on the competitiveness. You've talked at length that manufacturing is going to be competitive for Indian economy, but we've been a service-driven economy. So do you also see the same competitiveness in the service sector to continue that we've enjoyed in the past?
See, we have become a larger component of services because manufacturing has not grown. And as income levels go up, if you look at the household's consumption or expenditure, as you start earning more and more, your share of services will keep on growing much faster. And as I said, trade in services is of very recent origins. So, and that's why manufacturing has become very small because we have not been able to export. I think India has an opportunity to grow both services and exports. Local services will continue to grow. I think we will grow export services also faster beyond software for reasons what I discussed. And I think manufacturing is again, we should grow quite fast. And you can, actually we have been doing okay even in, so one second. If you look at the blue line there, that is India's share of manufactured exports globally. So we were 0 in 2000. So we have come up to 2.5%. So even with all the disadvantages, whatever, our direction of movement has been right. So I think the environment is a lot more conducive now, and this market share gains of 0.1% per year should become much faster. I think government's target is to make manufacturing 25% of GDP. I think currently it is 15%. I think services should grow, but manufacturing should grow even faster. But that will be very positive for services again, because to grow manufacturing you will create a lot of jobs. So yesterday there was a report in press that Apple has created 1 lakh jobs. So just imagine, I mean, Apple right now it will be so small in India. So when you move into manufacturing, it's a very big opportunity. So you will create millions of jobs. And these people, they will come back to consume services. So I think manufacturing, even if it grows faster, it will still be positive for services. But I think we are looking at fairly broad-based growth in India at this point of time. So I think we are running out of time.
Sir, how strongly do you believe in Make in India concept when it comes to manufacturing sector or the export market share? How strongly do you believe that Make in India concept, will it be a game changer, or what do you feel about it?
See, I think clearly, I mean, Make in India communicates to us the support of the government. And without government support, it will be more difficult. So I think it gives you the intent of the government, and I think Make in India is extremely not just good but very timely concept also. And I think it was here, yeah, you can see it here. India's ease of doing business ranking has improved from 134 to 63. This is nothing to be proud of. That's why it's not at the headline. It is in the, because 63rd is still 63rd. But it at least tells you that you are moving in the right direction. So I think look at Make in India as a initiative, encouragement, support from the government to do all of that is possible to encourage it. And PLI is one good initiative in this direction. So I have no doubt that with a supportive environment, comparative costs, keenness of global companies to reduce their footprint in China, for risk, geopolitical reasons, to increase their footprint in India, and government support and improving infrastructure, all of this come together, I think this should happen. Thank you.
So, I request you. All right, thank you so much. It was such an informative session. I must say, we got to know that how many people have AC, how many people have car, and how many people are yet to get the same. All right, so over here, may I please call on the stage Shrikant Nadella over here for the felicitation of Sir. Thank you. Everyone, a big round of applause for Prashant Jain and this amazing presentation. Thank you so much, gentlemen, for these amazing sessions out of there.